The relationships with the clients and the clients' confidence in their focus, the firm's focus on that mission is everything. And if they started going and acquiring businesses and scaling up and adding teams, it would send the wrong message, and appropriately so.
Welcome to the Wealth Horizon podcast, where we explore the latest trends, challenges, and opportunities shaping the financial industry today. In each episode, we bring you insightful conversations with industry leaders, sharing practical, actionable strategies to help advisors deepen relationships and move towards goals. I hope you enjoy. Hi, everyone, and welcome back to the Wealth Horizon Marketing Podcast. Today, I'm so excited to welcome Brad Mook to our podcast. Brad is the Managing Director of Investments and Finance at Rosemont. Rosemont partners with RIAs as a permanent minority capital investor. Rosemont invests long-term permanent capital in employee-owned asset and wealth management firms. And what I love about Rosemont is that it's focused on building enduring and collaborative partnerships, not changing a firm's identity or pushing for higher multiples at the expense of the culture or client service. Brad works closely with leadership teams to support growth, succession, and problem solving in a way that strengthens independence rather than diluting it. He has spent his career deeply embedded in the advisor ecosystem, and I'm so glad he's here. Brad, welcome to the show.
Thank you very much, Rosemary. I'm happy to be here.
I personally am so glad that we're having this conversation. This is a conversation I've actually wanted to have with you for a very long time. And I think it's going to be very rich and insightful conversation. You have decades of experience in the M&A space for wealth management firms. And I just think you have a wealth of resources. And so I want to start just by giving me a big picture of where you see us as it pertains to M&A in the wealth management industry, as opposed to like 7 or 8 years ago.
Sure. Well, I appreciate the opportunity to have this conversation. I think you and I have had some good ones in the past. I think one of the things that I've learned in decades in the industry is about managing expectations, and you've set a high bar. So I'm hoping I can live up to it, but let's
No
just chat.
pressure.
And we'll see how it goes, because I do think there are some interesting perspectives. And I would say over the past 5 or 6 years, we really have seen some changes in the M&A landscape in the wealth space and advisory space. 5 years ago, the conversation was about establishing a beachhead. We talked to a lot of firms about just trying to get a presence in wealth management, buying a firm, an office, a team, just getting some platform that they could get started with. And now we've evolved to the point where a lot of the capital providers and firms have that beachhead and have built on it. And so the conversation has changed to just pure scale, geographic pickups, capabilities in terms of service offering, talent acquisition, and it's become more nuanced. And I think that really has created a different conversation, more specialist conversation around the types of things that people are looking for. There's still some trying to catch up and just establish that beachhead, but it really is becoming more nuanced for those that have had their beachheads for a couple of years. Interestingly, I think now we're approaching the retrading era, where some of the PE firms that got involved 5 or 6 years ago need to rotate their portfolios and exit positions. And so we are starting to see some retrading of firms and cross collaborations where multiple firms are partnering up and things like that. So it's maturing, but we're still, I think, relatively early in the game.
So you don't see the activity in the M&A environment slowing down anytime soon?
No.
No.
There's still a lot of formation, business formation, and a lot of firms springing up. Some of them are being built to operate independently. Some of them are being built to sell. I mean, we talked to a number of firms that is their clear intention, to build their firm for 5 years and then sell. And I think there is a lot of opportunity for the transaction momentum to continue. I don't see any signs of that slowing down.
So I would like to talk about, what you see as the catalyst for so much activity? And why do you feel that advisors feel so much pressure to embark into an M&A activity centered growth strategy? And then like what's wrong with just plain old organic growth? What happened to that? And why do advisors feel that pressure to sort of jump into the M&A?
I love that question because that's really part of the essence of what we do at Rosemont is try to operate within that environment, and people do get caught up in it. There's a definite sense of FOMO, and that's the messaging from the press. I mean, we see, you know, firms put out research on transaction activity, and this quarter was a record-setting quarter, and there's no signs of slowing down, and this year is setting new levels in terms of volume and valuations and those metrics. And it can be easy to feel like you need to be part of that and to get caught up in that and say, well, if we're not doing it, we're missing an opportunity or we're doing something wrong. And the basic fundamental purpose of the advisory practice is serving the clients. And I think people sometimes lose sight of that, and it's easy to do so. Um, as you mentioned in the header, we are focused on helping firms be sustainable as an independent firm. Doesn't mean that M&A is off the table, but that's not our starting point. Our starting point is not massive scale, lots of M&A. How do we build? It's how do we create a good business that aligns everybody, the clients, the owners, the practitioners. And I think that's okay. And interestingly, there's a renewed emphasis on organic growth. I think as some firms are a little later in their M&A journey, at some point you have to turn back and just run a good business, and that requires organic growth. And I think there's also been attention paid to organic growth on valuations. All firms are not alike, and the multiples that firms get shouldn't be all alike. And so there is some differentiation going on with the organic growth. But that's the core of running a good business is the organic growth and having a healthy business. And I think that's where it starts, but we've lost sight of that in some cases.
I would agree with you. And in our earlier conversation, you said something that I thought was interesting. That you have to really decide what you want your firm to be when it grows up. And in earlier, kind of deciding, is this a firm that you're building for sale, or is this a firm that you're building for multi-generational wealth management purposes to serve clients? And then at what point does it negatively impact clients? Like, firms who are growing for like just for growth's sake, for just to hit the higher multiples, like, what does that do for the client relationships in the firm?
That's a touchy topic. I've been in the investment business 30 years and seen a lot of M&A in the investment business and outside. I used to be a technology analyst early in my career. I've never seen a press release or heard the rationale for a merger or an acquisition that wasn't good for the customer. It's always good for the customer. And the fact is, half of M&A doesn't work out. And I at least broadly, I'm not saying specific to wealth management, but that metric suggests that maybe it wasn't good for the client. Something didn't work. And ultimately, that it didn't deliver on the initial promise that was the headline. We often, with M&A in this industry, celebrate these things getting done. We very seldom look down the path and do a postscript on, okay, what ultimately happened and what was good, and what were the client retention rates, and what was the satisfaction rate, and how did that all work out. There are tons of legitimate reasons to do M&A, picking up new technology, new talent, geographic footprints. The list goes on in terms of things that it can do to help a business. But somewhere along the way, I think there's a tendency to lose sight of the client and ultimately the level of service. We have these conversations about scale all the time. A lot of the work gets pushed down in the personnel ranks to junior people. Things get automated, and you lose some of that client touch points that are so important. With the M&A, that revenue is being monetized by the seller, and that gets passed along. I think clients sometimes wake up and say, how did I get here? I started over there, and now there've been a couple transactions, and now I'm over here. And, a lot don't pay attention. For some, that may be great. For some, it doesn't make sense.
Right, right. Well, can you tell me a little bit about, from your perspective, what it looks like just to stay small and build a sound business practice? What does that look like in practice? And then I'd love to know your opinion on like when does scale actually make sense for a firm?
Yeah. I think so. A lot of it depends on motivation. And ultimately, what does the advisor want and what do the clients expect? And so I think there is a place in the world for all kinds of practices. And I was at Future Proof a month or two ago and, saw a panel on small firms and why it's okay to not chase into all the scale. And having, a handful of people and a handful of clients can be a great lifestyle business or can be a good fit. I think there are limitations to that in terms of your ability to provide for clients. I think the bar is rising in terms of reporting requirements, technology stacks and investment options. You look at the emergence of privates in a lot of portfolios, and that can be really hard to do for a single advisor who maybe has an assistant or is subscale. So there is some element of scale that's important in terms of being able to have a commercial business that can provide for clients well. That doesn't, for us, given that we back firms that we'd like to see stay sustainable indefinitely, that's a couple $1 billion. It doesn't have to be tens of billions or hundreds of billions in assets under management. It could be a little bit less than that. It's probably not 100 million. But that provides enough of a P&L to put oxygen in the business, to acquire talent, to have the proper resources. Look, for some, they're playing a different game, and building a firm that has 100 billion in assets and is a national player and nationally recognized brand name um, matters. I think I don't know if when we get there and we have a handful of firms that are that big that are household names, if that is really you know the ultimate destination. I don't know what that provides. It's not a panacea. I can assure you a lot of people are going to get rich along the way in creating those firms. And it's exciting to build things and to win. But I don't think that is necessarily what people have to aspire to do. So it really is, beauty's in the eye of the beholder. I think we don't all have to race to play the same game and experience the FOMO that we talked about. Um, but yeah, there's all kinds. Look, we have one firm that we've partnered with that has multi-generational families, and the focus is on passing the wealth from the early generations down through successive generations. And the relationships with the clients and the clients' confidence in their focus, the firm's focus on that mission, is everything. And if they started going and acquiring businesses and scaling up and adding teams, it would send the wrong message, and appropriately so. So for them, steady as she goes and kind of keep the train on the tracks is the job. And that's a very different strategy than an aggressive M&A strategy. And that's okay. Different strokes for different folks.
Hmm. Just a very different experience as a business. And I think there's an element of like, I mean, I work in the media. I try to get media coverage for a lot of people we work with. And, to some extent, the media just doesn't care about you until you reach a certain point in AUM or AUA. And it's not sexy. Like slow, organic, sort of steady growth is not as sexy as big numbers when you're talking about adding 400 million, 500 million. That's, there's something
Yeah.
to be said for that too.
Well, tell me about it. When we don't do very many transactions, we've been investing permanent capital now for 7 years. We've made 4 investments. That's not exactly a cadence that brings people out of the woodwork to cover what we're doing. Um, so, yes, it's hard to get attention. You and I have had a lot of conversations about how important that attention would be and what can be done to generate attention. Um, so it's okay. I think there's plenty of room for all of us.
For sure. So I want to talk a little bit about where you think we're headed. So if we look at the landscape right now, we look at the independent advisory firm, the beginning of the advisory firm sort of industry was built as an alternative to the banks and the large firms and the brokerage model and sort of growing a book of business and trading it like currency. I'm curious to know where you think we're going right now with this sort of race to create larger firms.
Uh, a premise that I've arrived at, and I've talked to others who feel the same way, is that we're going full circle. Not exactly full circle, but we're creating large firms that are the antithesis of what the small firms were created for. So people left wirehouses to start small independent firms. Now they're scaling up and ending up more or less back where we started. A few differences in business models and things like that. But at the end of the day, the clients who went and worked with the small independent are now with a big, bulge bracket type firm. And ultimately, are they well served there? Is that what they wanted? The advisors that work there now all of a sudden are, firms change as they grow. I will say this. So as firms scale, you need more rules, process. You have management hierarchies. They become more bureaucratic. Firms change as they grow out of necessity, and that's fine, but it does change the way they operate. I worked at SEI for 10 years before I joined Rosemont. And I remember talking to colleagues who started there in the early days when it was a couple hundred people and it was very innovative and entrepreneurial. And it has worked very hard to maintain that. But when I was there were 3,000 people, and now there's more than that. And it's very hard to maintain that innovative entrepreneurial culture as you scale. So business's DNA starts to change and you hold on to it as best you can. So I think this full circle moment, I think there are going to be people peeling off of these bigger firms and going and starting new firms in some cases to get back to what they were trying to do originally, be in a smaller firm and then not get caught up in the race to scale. Others are doing it very intentionally because they want another round trip on selling, building a firm and selling it and monetizing that. I did see a headline a couple months ago about undergraduates graduating and coming into the industry, and the quickest path to becoming equity partners to capitalize and create wealth on a sale, which I don't love that as being the tagline for why to go into wealth management, but that's what's happening. So it's challenging. I think anytime there's a lot of growth and a lot of opportunity, you're going to attract people with all kinds of different motivations. I hope we don't lose sight of the plot in terms of the fiduciary responsibility of advisors to their clients and providing the best outcomes for their goals. And there are tons and tons of great advisors and people who are doing that. And I love that about our industry.
Do you feel like that's getting lost?
I not lost, de-emphasized, and there are some who I think uh, are more motivated by personal gain. Yeah,
It's hard not to be though when you're talking about
I get it.
this kind of money. I'm curious to know how you feel. From my seat, I've seen a lot of the motivation to join forces with other firms, like you said, not just for growth's sake, but maybe strategically to expand footprint or take on new personnel. I'm curious to know how you feel about the trend of firms wanting to sort of swim upstream, so to speak, and serve clients in the ultra high net worth realm. From where I sit, I see many firms merging and then launching family office practices or, you know, sort of being able to expand into that arena with the merger. Are you seeing any of that? And what are your thoughts?
It's definitely taking place. I think everybody would love to add higher ticket clients and capture those fees. I think the hard part is serving them appropriately. Firms that are built for mass affluent or kind of high net, the more broad portion of high net worth, are not necessarily well equipped to serve the very high end client, centimillionaires and so forth. And it's different. Not to say it can't be done, but it is a very different service delivery model. And that was actually a topic of another panel out of Future Proof, was how to go get those clients and start by realizing that they're not like all the other clients. Um, Look, there are a lot of them, and they can be great relationships. But it is a little bit of a different animal. Some will be successful at pursuing that, others won't. I think there are firms that are dedicated to that segment that likely are better positioned to serve that segment. I don't know if culturally there's compatibility with firms that serve the broader market and putting those two together, acquiring your way into that ultra high net worth market. Um, but it's challenging. I think before people launch that as a strategic initiative, they should do some homework around understanding what it means to serve that market and the capabilities that you may need to add and the limitations that you may have in terms of being able to partner with them and what that implies in terms of working with third parties and other specialists.
It's not the same, for sure.
Not the same.
Can you tell me, when we spoke before, I'd love to hear your take on an example of when a merger makes sense. What are some of the things that you look for in your role for advising the companies that you work with when that merger makes sense? And what are some of the lessons learned that you've seen in these successful relationships?
So I always start with people. It's very easy to map something on paper. Usually people will start with the economic um, viability, and what happens when you merge two businesses. Certainly, strategic capabilities matters, and looking at that, where's the overlap? Where is it incremental? But I always start with the people. I think culture is so important, and the compatibility of different people really matters because at the end of the day, most of this industry is about blocking and tackling, and it's the personal relationships that cause the issues. So a lot of our time is spent just counseling people emotionally, calming them down when they get too upset or too excited, or helping to resolve conflict, because there's a lot of that, and that can be the biggest hurdle to effective business execution. Um, there are a lot of different rationales. An interesting example of a good combination that we were very close to out of our final private equity portfolio. So we used to have PE funds. We had to exit those investments. That's one of the reasons that we switched to permanent capital 7 years ago, was so that we could establish long-term partnerships and not have to exit the investments. But we had some that we needed to divest from, and we're not prescriptive in terms of who they sold to or how we exited. Sometimes we sold back to management. Sometimes we would sell to a third party, our stake to a third party. Sometimes they'd sell the whole company. It was really their call as long as it facilitated the exit that we needed. And and so they could pick their path. And in some cases, it was an aggressive growth path. And so, they'd sell to a private equity firm that would provide them a ton of growth capital and really push on the accelerator. And other times, a more conservative path. And one that we exited was Clearstead, which was a pretty good sized institutional advisory and private wealth firm based in Cleveland. I think it was around 30 billion at the time. Now it's meaningfully north of that. We sold our stake to FlexPoint Ford. Management sold some alongside us, and that was a successful transaction in its own right. We had another firm that we wanted to exit or needed to exit, WST, Wilbank Smith and Thomas, and ended up selling that firm to Clearstead. So that's a combination of two firms that we knew very well because we had been invested in both. And it really was a good case study in compatibility and how they fit together. Different personalities, really a different business model, complementary in some ways, different in other ways. Clearstead has a very purposeful model around having a single brand and single approach to the way that they approach the business. And so not just bolting on other businesses with other brands and letting them operate independently. But WST had a very clear intention that it wanted to continue to do a lot of the things that it was doing that weren't already in the Clearstead business practice. And so that was a study in people too, in are they like-minded? Do they want similar things? And so can they get to a solution that works for everybody? Not perfectly. Everybody's in a negotiation got to give up a little bit. But it ended up being a really good combination that was additive to Clearstead as a whole. So it was 1+1 equaled more than 2. Um, but uh, preserved some aspects of each and created a stronger business in the end, and they're doing very well. So I think every combination is different, and there are pros and cons and things that are acceptable or not acceptable. Really, can the people work together and figure that out in a way that makes sense? No silver bullet, but having good partners is a good starting point.
Okay, so I'm curious to know, what would you consider to be like red flags, like deal killers, right? So people people go down the road. I've seen plenty of deals fall through. Many of them fall through at the like 11th hour. So I'm just curious, from your perspective, what are some things that you see that cause deals to fall apart, or that maybe should fall apart and don't?
Yeah, right. So maybe things that had they fallen apart instead of getting done,
Right.
we'd end up with a higher success rate in terms of post transaction success. I, I
Exactly.
I I call me consistent. I always go back to people, and
Mm.
I think selfish behavior heading into transactions is always a problem. We see this with um, potential investments when we're talking about, or firms in general that we're giving advice to on succession, equity succession, and there's typically a gap between buyers and sellers and what they want. And the way things get done is people make concessions and nobody's perfectly happy, but everybody's a little happy, and we've all agreed on a greater common good. And that's the North Star, is the common good and the firm, and not the individual people. And our philosophy is always, if we collectively do a good job building the firm, the which we define as sustainable, uh, a sustainable, healthy business. That's the North Star. If we do that, the pie gets bigger, and everybody is going to win to that. So what? Back to your red flag question. What goes wrong is when people start focusing on their piece of the pie rather than the pie as a whole, and that creates conflict and tension, and negotiations break down on that. So selfish behavior, and it could be, it's not just money, it can be other things as well. It can be titles, it can be responsibility, reporting lines, any of that. Can be an issue, but often it's people. I mean, there are other things that complicate combinations. Business models is a big thing. I mean, there's the RA versus broker dealer business model and how advisors get compensated. And when you're bringing a firm that is, more compensated based on a percent of book or revenue, and moving them into a model where most people are W-2 and getting paid from, the corporate pool, that's a philosophical misalignment that can be difficult to overcome. Again, I would take that back to, that's about people, and people worried about their own piece of the pie rather than the whole. We've been big advocates for employee ownership. That's really our ethos, and liking to be invested in majority employee owned firms, because that mentality of equity ownership and being more concerned about the firm as a whole, and that's where the risk and reward sits, we think is very unifying. It's not perfect, doesn't always go right, but it's a great starting point when everybody is rowing in the same direction.
Hmm. I'd like to talk a little bit tactical. So, what should a firm do if they are considering a sale or a merger? What are some of the, like, how should they think about timing? And are there things that they can do to prepare for this eventual course of action?
Yeah, so the preparation should start early, and early and often, professionalizing the firm so that you always, I'm a big fan of keeping the playbook wide open as long as you can. So creating more optionality and having a professional business where your books and records and your financials are in good order, and your tech stack is operational and has, room for growth, and your org chart makes sense for a more commercial environment, functional responsibilities, not just, the founder wears six hats, and that would be difficult to replace. The sooner firms start thinking about that and getting their organization more commercial and professional, the more options that they'll have. It becomes easier to sell the firm. It's generally going to be a better run firm that may have, in the long run, a better margin structure. There are a lot of benefits to that. There's not a whole lot of downside, maybe trading off a little bit of profit margin along the way, which not everybody likes to do. Everybody likes cash flow. Um, but that I think keeps the door open for a firm that wants to transition internally. Uh, having a well-run business where there's opportunity for people to grow and take on responsibility within that context is attractive to the next gen and might impel them to buy some equity and to be willing to take on some of the risk of owning the firm because they see a good firm and they want to take it into the future instead of, it's maybe the first generation's hobby shop and lifestyle business, and they won't ever get that opportunity. If you want to sell the firm, it becomes much easier to talk to a potential acquirer and say, look, here's my business, here's how I've set it up, we're in great shape. We've seen a number of occasions where firms have been approached and they are not ready. And it even happens with banker processes. And, let's say you get to a point where you need to or want to sell the firm, being able to expedite a process or at least show yourselves well in a process really matters. And we've seen firms that is not the case. I can tell you, we don't tend to participate in banker processes too often. But we see materials and we've seen some. And in some cases, you say that is a well run firm because they have their stuff together. And in other cases, you say, well, that's not a good sign. If they can't produce X, Y, or Z about their business, how are they running their business?
Right, exactly. And, what are your thoughts on like capital investments in the company? So if you're thinking about merging, if you're thinking maybe it's time, you mentioned just a minute ago, maybe making sure your tech stack is up to snuff. Do you feel that making capital investments in things like tech or personnel or what have you is wise before a merger or something like that? Or do you think that people should sort of, if they're thinking this might be a path for them, they should sort of hold for a minute before making significant capital investments?
I think if you're on the verge of a transaction where you're going to sell to a bigger firm that already has that stuff, then it doesn't necessarily make a ton of sense to go through the effort and the investment. Um, but if you're not sure, I would lean into making the investment. Um, I think it provides optionality. I mean, we've talked to firms that aren't sure what their path will be. They could be sellers or buyers. And if they are looking to acquire smaller firms and bring them into the fold, having a good tech stack and a good org chart really is helpful in that process. Um, on the flip side, if you're selling the firm, I mean, a well-run firm is probably worth more and probably garners a higher valuation. So there's a little bit of a managed risk in that, and you don't want to lay out a lot of capital if you're not going to get a return. It's like redoing the kitchen on your house, right? If you may not get it back dollar for dollar if you turn around and sell the house. But in the meantime, if you don't sell the house or you can't sell the house, you have a nice kitchen. And
Makes it
so,
better to live in.
yeah, sure, why
Sure.
not? Why not clean up your own house and enjoy living there while you're there?
Yeah, for sure. Okay. I'd love to know, what did I not ask you that I should have asked you?
Interesting. I'm going to turn that back on you. And we touched on organic growth, and I said it's becoming increasingly an area of emphasis that people are paying attention to. Um, you're about marketing and helping to drive that. What's working in terms of marketing as it relates to generating organic growth, and what are you seeing in terms of, is it you know digital, doing podcasts? You were very helpful in helping us get started with our podcast. But what things are you seeing that are working that we can adopt?
Well, I kind of go back to what's tried and true. The most important thing for growth is consistency in marketing. So if you are hesitant on, sort of starting the marketing engine, I would say make sure you're ready because it's so important to be consistent and regular in your marketing efforts. We're seeing a very large amount of success and growth around podcasting. It is it's the only content medium that I've ever seen in my whole career where people go back and listen to old content. So it's a great way to establish yourself as a thought leader. It's often easy for people who are in the advisory business to have long conversations about stuff that they already know. Advisors really like to talk about advisory stuff. We see that, and they enjoy podcasting. So we see that podcast, like tactically, podcasting is a really strong engine for growth for a lot of basic reasons. And then I would say also something that I think people almost forget about the importance of is the external presence, the website, does your website serve as an engine for growth? Or is it going to turn people off, and is it gonna serve as a deterrent? Because we see that a lot too, so I think that's really important, and I think having a firm idea of who you're trying to reach in your marketing efforts, so your ideal client profile, things like that, I think that's really important to have, all of that in place before you start marketing.
I think that's a great point. We talked about having your house in order from tech stack and org chart and things like that. Your marketing footprint as well. I can't tell you how many times we go to a firm's website, and I mean, some of them look like they're from the 1990s, maybe,
Yeah,
and
I've
like
seen them.
there's signaling in that. I don't know if it's fair or accurate, but certainly, it's sending signals to the marketplace, and things like that are they're not easy cleanups, but they're pretty straightforward. And I know somebody who can help with that.
I happen to know someone also who can help with that. Um, okay, I do wanna ask before we hop off, what's your favorite podcast these days?
Okay, so this could be a whole nother episode because I love podcasts. I listen to
Yeah?
a wide variety. I tend to focus more on topics and guests than I do the actual podcast itself. And so I've accumulated a pretty big list. I'll throw a couple out quickly. I'm a big fan of The Knowledge Project by Shane Parrish. He has a blog called Farnham Street, which is about mental frameworks and how we think about decisions and structuring our lives. And in this podcast, he talks to a lot of interesting people, and that resonates with me. There's another one more investment focused called Don't Get Fired by Ashby Monk and Daniel Adamson. And that interviews largely pension related folks about innovation. The premise being, how do you innovate without getting fired? But there's a lot of talk about building investment businesses in that one. Fund Selectors by Lucy Walker is another good one. Um, there is another one that I highly recommend to people, and that's the Rosemont Roundtable. If you've heard of
I've
that,
heard of that one. That one's excellent. I can
yeah,
speak from experience.
um, yeah. So those are a couple, and then outside of investments or finance, I'm trying to figure out how to play golf. So Hack It Out Golf I find entertaining, and there's another one called Strong Songs. I can't remember the guy's name. It's Kirk something, and he takes songs and decomposes them to like the different instruments and the musical theory behind them, and it's really fascinating. I don't all of the songs aren't of interest, but like he'll take U2 and tear down a couple songs by U2 or Bruce Springsteen, or it's really fascinating. So
Hmm. Okay, so
yeah.
I'm gonna put those in the show notes. I'll put them, in the links below so people who are listening can access those. Those are different ones than I've heard, so we'll definitely, provide people with an avenue to click on those easily. And then, I'd love to know, for people who are listening, if they're interested in reaching out to Rosemont, how can they get in touch with you?
Certainly shoot me an email. Go to our website, which is rosemontinv.com, and our contact information is there. We love talking to people. We love talking about all sorts of issues related to wealth and asset management. So, like I said, we've done 4 investments in 7 years, so we're not very transactionally focused. We're much more about knowledge and network and just trying to help people and learn. So that's our MO, and we'd love to hear from people.
Perfect. Brad, thank you so much for taking the time to be here. I really appreciate it, and I enjoyed the conversation very much.
So did I, and I appreciate you asking me to be on. It was a lot of fun, and I always enjoy talking to you.